Next speaker, Brett Crosby, who is the co-owner of Custom Ag Solution out of Wyoming. And we're going to just turn him loose and let him inject us with all kinds of knowledge. So it's all yours, Brett.
Well, I don't know how much knowledge you're going to get, but we'll see. I am happy to be here. Can you see my screen?
Yes.
Okay.
If you want to go to the presentation mode, that might make it a little larger for folks.
Yeah. Let me figure out how to do that.
Down at the bottom on that red ribbon. There.
Okay. Share screen. Just gonna share the whole thing. And then we'll go. How's that? Is that better?
That's better. That'll do. Sink a spur and go.
Okay. All right. Today, I'm happy to be here. I've been in Nevada before, but it's been a while. And so I'm excited to at least talk with you all again. I appreciate the UNR Extension inviting me. And today we'll talk about cattle market dynamics, some of the challenges that we're seeing and the opportunities that we have. First, I'll just give you a quick background. I'm a rancher here in northern Wyoming and southern Montana. We've been here I'm the 5th generation, and I run a cow-calf operation with some stockers. I will market my cattle either backgrounded or off grass, or I retain ownership as well on some of them when the numbers are right. I'm also a partner in Custom Ag Solutions, which is an economic consulting firm that has been going since 2004. And before that, I was an accredited rural appraiser. The Custom Ag Solutions is located in Cowley, Wyoming, right on the Montana state border. I own as much ground in Montana as I do in Wyoming. And our little corner of the world is a lot like Nevada in terms of its arid climate. We do have some high elevation grass that's very productive, but there are a lot of big pastures out here. I grew up riding a 86,000 acre pasture that ran about 800 cows. So I can relate with you a little bit. Custom Ag Solutions our focus is in market research and price forecasting, specifically in the cattle market. We also do a lot of risk management research and outreach education. And in recent years, we've focused almost primarily on cattle market forecasting and research. And so today, let's talk about the cattle market dynamics, and we're going to do that in 5 sections. First, we'll just quickly go through the supply chain. I don't know how many of us really pay attention to what happens to our cattle after they leave the place. And I think it's important for us to understand that so that we can understand some of the challenges that we're facing and why we're facing those challenges. We'll talk about those challenges that seem to be at the forefront of many of our minds right now, some proposed and possible solutions. And then we'll wrap it up with just some general advice on how to survive this current market environment and try to stay in business just one more year. That seems to be our goal. Just give us one more day. So let's start with cattle market dynamics in the supply chain. We know that your cows calve, you sell your calves, and they'll go either one of two places. They will either go to a finishing feedlot if they're heavy enough. Generally, the cutoff's around 600 pounds. Some feedlots will take them lighter. A lot of feedlots like them heavier. Most of the lightweight calves under 600 pounds will go to a backgrounding facility, either where they will be backgrounded in dry lot or they'll be fed on grass. And from there, they go to the finishing feedlot, and then we send them to the processor. And that the processors now are 80% of the beef that is processed in the U.S. is processed by 4 companies: Tyson, JBS, Cargill, and National. And so they will process both our steers and heifers, and they will also process our cull cows, and that's where the country's beef, domestic beef, originates. Then there is a step in between the packer and the retail outlets, and that's the distributor. So this is the middleman like Sysco or Food Services America that buys a lot of the beef that Tyson, Cargill, JBS produce, and they then will sell it to grocery stores, and they'll some of the bigger grocery stores will get their beef directly from the packer. Some of your big box stores, for example, will get beef directly from the packer. But most of the beef that is purchased by retail outlets comes from the distributor. So there's your middleman. And then finally, we have the food service industry, restaurants, and all those places that prepare food for people will buy from distributors. And that's just a quick rundown of the market supply chain, and that's important because as we talk about supply and demand, remember that as the supply goes up, price goes down, and supply goes down, price goes up. We all understand that, and actually we see that in the cattle market. There is a very strong correlation between the per capita supply of beef that we produce or that we import minus what we export, and the price of live cattle that hit the processor. Each of these dots is the average annual live steer price in the 5 marketing area, and you see 2020 is pretty much right on the regression line, believe it or not. The average, I think, is 108 and change for 2020 for live cattle. It would have been higher but for a few things. Obviously COVID took a bite out of the cattle market, but really what has hurt us in recent months is slaughter weights, which have been much higher than year over year. We tend to look in the cattle market at supply and demand like this. Okay, we are going to supply cattle, and the amount of cattle that we supply is a direct function of the price at the retail counter, and that just is not exactly true, because supply and demand laws apply to each step in that supply chain. Remember that there are a number of different steps from the ranch to someone's plate. And in each of those steps, supply and demand will determine the price structure between those steps. So for example, let's take 2012, 2013. We were already liquidating. We were in liquidation phase that started in 2007. It really accelerated in 2008, 2009, 2010 after the financial crisis. But then in 2012 and 2013, a widespread drought accelerated that herd liquidation, and we had record low inventories, which meant a record large or small calf supply. So feedlots paid way high prices for calves because they were trying to fill their lots. We had a low supply of calves, and hence when the supply is low, price is high, and we were getting $3 plus for a calves. I would love to see those days again. Now, in 2014, that carried forward because we had then fewer cattle on feed. It takes about 18 months for that to work through the system after the calf crop is weaned. And so in late 2013 through early 2015, we had a much smaller fed cattle supply, and packers paid higher prices to keep plants running. They had to keep plants running at least minimum capacity in order to stay in business, and so they were paying up. And as a matter of fact, they in the spring of 2014, they found themselves in a position where they were very short bought, and they had to pay through the nose for live cattle. Then along comes 2015 and 16. Fewer fed cattle meant a smaller beef supply, and so then the people who had to pay higher prices were the distributors. Now the price to the distributors is where we get our box beef cutout, and we saw that the box beef cutout was much higher because there just was not enough supply to satisfy all of the distributors' orders from retail outlets and food services. So in that time, because there were fewer fed cattle and plants were operating at a much lower capacity level, we had a lot of small plants exit the industry, and that's going to come around to bite us in later years, as we'll discuss. But you see what we're talking about in this chart. You see the spread between live cattle and box beef until about 2014, and then you see it narrowed substantially in the 2014-2015 period. And now you're going to say, well, yeah, but what about now? Okay, that's a good question, and we're going to get to that. What happened is as cattle inventories increased, so we had lower cattle prices because we had more cattle. We had fewer processors to sell those cattle to. So we had less capacity to process cattle, which meant that we had a packer consolidation. And when we have a packer consolidation, we see in 2017 a demand shift, meaning that the lower numbers of cattle now won't affect the price of live cattle as much as they would have in 2014 and 13 when we had much more processing capacity. So what we see, and the top line is packer capacity. In other words, it's capacity utilization. We see that when we get above about 90%, the prices start to level off or decline, and when we get below about 85%, we get a real spike in prices. 2009 being obviously the exception. 2004 was a result of the mad cow deal, and prices did spike, but it is not as it's not as dramatic on the graph, because remember, we also lost our export market at that time. But you see, as capacity utilization started to drift down from 2002 down to 2010, we also saw prices start to drift up. That is important, because what we see now is capacity utilization, because we have fewer processing plants in the country. Capacity utilization is staying well above 90%, and that means that, well, to give you an idea, the big four kind of target a 90 to 92% capacity utilization rate as optimal. So if they are if they're running cattle through at 90 to 92% capacity utilization, they're not going to be as aggressive at pricing cattle as they would be if they were running at 85 to 87% utilization. That's why that's one of the reasons that we're seeing cattle prices go down, even while box beef prices are going up. But the recent, and I'm talking 2014, 2013, 14, 15, recent beef shortages have also encouraged aggressive supply management, which has contributed to the packer margins that we're seeing today. So specifically, packers want to manage supply so they don't get short bought. They want to be able to fill all their orders to the distributors. Feedlots want to stay in business. So packers and feedlots got together, specifically large corporate feedlots, but not exclusively large corporate feedlots. Packers provided incentive for feedlots to sell via either formula agreements or exclusive agreements. And by exclusive agreements, I mean one feedlot will make an agreement to sell exclusively to one packer. I'm thinking of the Five Rivers in Greeley with their agreement to sell exclusively to JBS. This gave feedlots a financial incentive, because they make more money doing this, and it gives the packers the ability to manage their supply a little bit better. because they know they have some cattle coming. If they have an exclusive agreement, they know they've got cattle coming. This is a function of rational players in a free market. It's legal. No one at this point has done anything illegal in negotiating these agreements. I want to make that clear. I'm not saying that there's not collusion. I'm not saying there is. I'm just saying that these agreements are currently legal, and they are a response to incentives that both packers and feedlots have to manage supply and stay in business respectfully. So now let's talk about some of the challenges that dynamic has created. First of all, we have a problem with price discovery, because the formula financial incentive, or in other words, the financial incentive for feedlots to either trade on the formula or have exclusive agreements, has increased the amount of formula trade numbers. It's dramatically increased the amount of live cattle that are traded via a formula. And by formula, I mean they turn them in with a base price, and then their price is adjusted according to how those cattle perform on the grid. Now, because these formulas are not finalized until the grid, until they actually die, the formula price reporting lags cash by 1 to 2 weeks. That means that people who are out there trying to get a cash bid have no idea what the formula traders got that week. And so some regions, cash markets have become very thin. In Texas, for example, where there are a lot of large corporates, we see cash trade dip down as low as 3% some weeks. The average, I think, is 8 to 10%. Kansas is trending that direction, although not nearly to that extent. They're hovering around 17 to 20% cash. Nebraska is around 25% cash. And then as you get into South Dakota, Iowa, they're 50% plus. But because of all this, timely price discovery has become very challenging. And what I mean by that is we have a lot less data to rely on to know where the market is exactly. It's kind of like getting ready to send your calves to the sale and looking up the last sale and seeing that only 12 500-pound calves were reported sold. Well, that doesn't give you a very good sample size, and so you're going into this sale a little bit blind. Small to mid-sized feedlots who are predominant in the Iowa, South Dakota, the Corn Belt region, have been affected the most because they're primarily farmer feeders. They don't really have enough cattle to justify an exclusive agreement. They don't want to sell on the grid for whatever reason, so they don't want to do a formula. They're the ones that trade the most cash, and they're the ones that have been affected the most by this price discovery issue. We also have an issue with exclusivity, and this is this, in my opinion, is just as large a problem because the financial incentive given to feedlots to be exclusive to one plant or another is substantial. I have fed my cattle. I send my cattle to a custom yard and one of several custom yards. One of those had an exclusive agreement with JBS for a while, and um, and and it was a good deal. It was a sweetheart deal. So there was a lot of incentive for that feedlot to keep an exclusive deal with JBS. Large operations, exclusive agreements increase packers' pricing power, because if you have an operation that feeds 4 million head a year, then you suddenly have a packer that knows they have 4 million head coming down the pipeline. And they have a pretty good idea when those 4 million head are going to hit the pipeline. So they can adjust their cash bids accordingly. And at times cash just becomes a cleanup for whatever they want that they didn't get through formula or exclusive deals. I'm not making the large corporates out to be the bad guys necessarily, but because they feed, well, I'm not making them out to be the bad guys at all, but because they feed so many cattle, to give you an idea of the feedlot concentration, private estimates from several industry experts estimate that anywhere from 20 to 35% of the nation's cattle are fed by 5 different companies. And so if a packer can get an exclusive arrangement with one of those 5 companies, then they have a lot of pricing power, and they have a lot of ability to manage the rate at which their supply hits their processing plants. In effect, it creates a quasi-packer ownership. The reason that the Packers and Stockyards Act limits the processor's ability to own cattle is specifically for that purpose. They don't want to give the packers an unfair pricing advantage by being able to control supply, and these exclusive arrangements allow them to do just that. Again, I want to make it clear, this isn't illegal. This is something that is legal. It's certainly a loophole, but they're not breaking any laws by doing this. Okay, here's an example of how that really affects the cattle market in periods of capacity shocks. And I'll take the Holcomb and COVID capacity shocks, where we lost capacity for 2 different reasons. Packers gave preference to forward contracts first, because that was an agreement that they made to contract to buy cattle during a specific month. Then they give preference to exclusive operations, and then they give credit. They give the next people in line are the people who have a formula arrangement with them. The remaining capacity is filled with whatever cash trade they can find. Now, during these periods, there is a very positive basis that gives cash traders an incentive to accept a lower bid. Let me give you an example. If a cash trading feedlot in Iowa hedges at 120, for example, and someone comes along and offers them $5 lower, and that's at 110, but the basis is 15, then they get 110 plus their $15 basis. So they're actually realizing 125, which is a higher number, a higher price than they hedged. They're going to take that. They're going to take it all day long. So hedged cash traders give packers ability to fill capacity at lower prices than they otherwise would. And this is a graph showing these two periods. On the left, you see the Holcomb fire fallout, and the blue line at the bottom is the cash trade. The red line circled at the top is the basis, and you saw when basis got to about 15 bucks, 10 or 15 bucks, then all of a sudden these hedged cash traders were saying, yeah, I'll take $1.15 instead of or I'll take $1.10 instead of $1.20. I'll take $1.05 instead of $1.10. It allowed cash to drop precipitously, and notice that formula prices stayed relatively constant through that period because they were the first people to hit the processing facility. Then over to the right, you see the same issue when COVID hit. We peaked in February. Everything started to go down, formula and cash both. But notice the red line. The basis went from about 0 in February to plus 25, 27 it got to in April. So that gave people who were hedged an incentive to sell at a lower price, and they kept selling at a lower price because basis kept staying in the $10 to $20 range. And so cash bottomed out at $1, where the formula trade was about 15 bucks higher. That's not to say that this is an easy problem to solve. This becomes a very tangled web because while formula net prices, the price that comes out 2 weeks after cash does, averages $3 to $4 more than cash prices, formulas still need cash reporting to establish a base price. Most formula base prices are set according to the cash price that week. The base price, for example, in Northeast Colorado for my cattle with Cargill was the highest Nebraska cash price for that week. So we need cash to establish a formula price. Now this causes some hard feelings among the cash traders because they have to, as soon as they negotiate a trade, they have to pick up the phone and they have to report it. They have to report it's a mandatory price reporting. They have to report the price that they received. And then the formula traders get that report and then use that to establish a base price for a formula that gives them $3 to $4 a hundred more than the cash guys are getting. So the cash guys feel like they're giving value away when they have to report a price immediately, and they're not getting anything back in return for it. But formula trade has been a net benefit to the industry. The formula trade, we don't want the formula trade to go away, because first of all, by selling on the grid, people who participate in formula trade realize profitability from selling cattle that do well on the grid, and because they have incentive to produce cattle that do well on the grid, these quality-based incentives have created more choice in prime cattle than we've seen historically, which is positive for retail demand. Anymore, choice beef is what people expect to buy. Select is no longer the standard beef of choice, no pun intended, in the supermarket, and that's been a good thing, because it's kept box beef prices, it's kept demand high. So what do we do? Formula trade is a good thing, but at the same time, the guys who trade cash kind of get a raw deal out of it, because they're not capturing any of that extra. They're not capturing any of that extra value. So, what are some possible solutions? Well, the U.S. cattlemen first came out with what they called a cash mandate. Originally, it was 30% cash. Everyone has to trade 30% of their kill in cash, and they also have to be killed in 14 days. That turned into the 50-14, primarily because Senator Grassley sponsored it, and Iowa was already at 50%, and he didn't really want to introduce a bill that mandated a smaller proportion of cash than his state was actually trading. Well, there's some pros and cons there. Obviously, it ensures a lot of cash trade data, and it narrows the delivery window. But there's some substantial drawbacks, and they can't really be ignored. A cash mandate may not be possible in some regions. Think of Texas, that's only trading around 8% cash. It's going to be pretty hard for them to suddenly change from marketing 8% of their cattle under a negotiated cash trade to 30. 50 would be out of the question. The bigger concern in my mind are unintended consequences. I think of Reagan's quip that the sentence that scares people the most is, "I'm from the government and I'm here to help." Anytime we have a new regulation, it is seen through a myopic spectrum, and it is often unintended consequences are often ignored. At the very least, they aren't considered to their fullest extent. So this summer, the NCBA got together and they proposed a self-regulation structure that would trigger some cash pricing mechanisms if cash price fell below a certain percentage in different areas. Obviously, the biggest pro to this, or the biggest upside to this, is it limits the amount of government regulation and intervention we have, and there was feedlot sector buy-in, which is important when you start to try to dictate how people sell their cattle. I don't want to be told how I sell my cattle, and I imagine most of you are the same, and I think feedlots are the same way. The drawback to that, though, is that on the cow-calf side, in the cow-calf sector and the farmer feeder especially, there is a lot of skepticism about whether that will actually do any good. If it is, there is a question about whether it's too little, too late, and I don't know the answer to that. But it doesn't have nearly as much buy-in on the cow-calf stalker and small feedlot side as it does the large feedlot side and the packer side. The bigger problem, though, is that these exclusive agreements between large feedlots and packers can continue under this self-regulation proposal. So we have those proposed solutions. And in full disclosure, I will tell you, I've worked with the U.S. cattlemen since February. I presented there were 2 reports presented to Congress about regarding the effect of COVID on the cattle industry. The team led by Daryl Peel wrote one report, and I wrote the other report. Both took entirely different avenues and approaches, and we came in within about 3% of each other on our final number. I've worked with many people on that team, and I respect them a great deal. But that began my work with the U.S. cattlemen, and while I disagree with, I often disagree with them on a variety of issues. I am a member of the U.S. Cattlemen, and that I want to make sure that is fully disclosed. I also believe that the NCBA is a good organization that has a lot of power in Washington, and I don't think we want to see the NCBA go away. I actually think that they are both good organizations. So there are your proposed solutions from each of those organizations. Now I'm going to give you Brett Crosby's opinion. This is just my own opinion. You can take it for what it's worth. I'd say it's worth what you paid for it, but it's probably not even worth that much. I believe that the MPR needs to change. I believe mandatory price reporting needs to require timely formula reporting, meaning that as soon as a price is negotiated, anyone who sells via formula needs to report the base price as well as the grid structure. And by the grid structure, I mean the premiums and discounts for the different grid qualities. That will give the market enough information, having known what the grid premiums and discounts have been averaging recently, and adding that to the base price to give them enough of an idea to know what those cattle are going to be worth. And it will give back to the people who trade cash. It will be a good, it will be a fair gesture to them. Obviously, there is confidentiality issue. I believe that the base price and grid structure should be aggregated at the AMS level, kept confidential, and reported as an aggregate number. In addition, I believe that the Packers and Stockyards Act needs to be amended to count exclusive cattle, and in other words, cattle that are marketed exclusively to one particular processor. Those need to be counted toward the Packer ownership number, because they are for all intents and purposes, they serve the same function as the Packers owning them themselves. They give the Packers the same pricing power. Finally, using the cash and formula data, I think it would be helpful for us to have a cash index that gives us a good idea of the actual cash price, or the actual price received for all cattle. And that means cash cattle, that means forward contract cattle, and formula cattle. This gives us a better estimation of where the market actually is, and it will, I believe it will ultimately lead to a more stable and accurate live cattle futures contract. So we've talked about possible solutions. We've talked about the challenges that those solutions are meant to address. Let's just talk about the current environment for a second. The current environment shows that herd inventory is slowly declining, even though we still have large numbers on feed. We're getting some heifer liquidation that's increasing the numbers of cattle on feed, and we had a pretty decent sized 2019 calf crop because we had a good calving season. So the liquidation of heifers and cows is keeping cow slaughter inflated, but the good news is that our estimates expect 2020 calf crop to be 1.8 to 2.2% lower than 19, and the beef cow herd I expect to be 1.5 to 2.2% lower, which means that we're on the upside. Once we started herd decline, it took us about 3 years, 2 to 3 years to come out of the throes of our depressed prices. And you see here are the price cycles going back to 78, 79, and you see that there is a range of those price cycles, and while the prices dip in above and below those ranges, you see that in general the bottom of the new range is likely to be the top of the old range, which means we're probably looking right now. We see a live cattle range of 96 to 132. And feeder cattle anywhere from 122 to 162. That means that in the next cattle cycle, which I expect us to break into in the next 3 years or so, we could or sooner, we can expect a floor, so to speak, of around 132 to 162. And I'll defer to the cattle market experts on that. What I really want to talk about is just surviving. Keep your costs low, identify opportunities to add value. And I just sold some calves on the Northern video auction. The program calves were easily $40 to $50 a head, more than cattle that were of the same quality and not program cattle. And information and knowledge are what give you the power to be flexible. As you manage your risk, remember that risk encompasses all possible scenarios. Good risk managers plan for the best, prepare for the worst, and forecast the most likely scenario, even though there is a probability distribution around that forecast. And now I'm going to give you a plug for our website, beefbasis.com, which is it's a price forecasting website for cattle between 300 and 900 pounds. Marketed on a specific date. There are a lot of tools out there that I encourage you to use. We don't have a model yet for Nevada, but we are working on one. Meanwhile, you can use Utah, or you can use one of the mountain states and know what your if you know how your cattle compare to the mountain states. With that, I appreciate your attention, and I hope you have a profitable 2021. Whoops, typo. You can reach me at bcrosby@casnow.com. You feel free to call me anytime with questions, and I am an avid tweeter. I will I tweet a lot of pictures and anecdotes of my kids, but I also will give my opinion on market conditions.